Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Welcome back, everybody, to the DIY Wealth Canada podcast. I'm Nelson, along with Bob. He's your co-host. And today we are going to be talking about our biggest investing mistakes. This is going to be a fun one because Bob and I get to tell you the stupid decisions that we made and how they're probably pretty similar to the other stupid decisions that other investors have made. So I'm excited about this one. Bob, are you ready to tell the whole world how much you suck?
Oh yeah, absolutely. I think we could go on and on and on and on about our investing mistakes here.
Absolutely. And of course, I joke that, we're going to tell the world we suck, but I think you're going to find out these are the exact same mistakes that most everybody makes. And yet we still made them. We read about them. We heard about these mistakes and we still made them. So Bob, let me ask you to start with, before we actually get to our mistakes, why do you suppose investors are so confident that they think the previous generation's mistakes aren't going to apply to them, that they have some sort of insider knowledge that will protect them from making the same sorts of mistakes that everyone before them has made? Why do we do that? And why are we so stubborn to not figure out that people before us have kind of blazed this path and we just ignore that?
I think one is like we're all humans, right? So we make mistakes. And two is when people start investing, they're too confident and kind of thinking that they know better than people that are before them. So that's you just tend to make mistakes that people have made in the past instead of learning from them. And a lot of time you have to make these mistakes yourself for you to learn, right? Reading books and reading about the mistake is one thing. When you start actually making them, that's when you hopefully start learning about your mistakes and make changes to how you invest.
Yeah, I think that's a fantastic way to look at it. And I completely agree. The confidence of an investor with just a little bit of experience, the person who first starts out, they know that they don't know anything. It's that person with just that little bit of experience, that confidence of maybe a few successful investments, maybe, one that went up a whole lot. That's the danger zone when it comes to that psychology of I know better than everyone else. And it's almost like you need to have a failure at that point in order to really cement that fact in that, hey, I don't know everything. In fact, I really don't know much at all. And that's overall the best thing that can happen to a investor, is that you make a mistake, you look back on it and you say, wow, like what was I doing? But at the time, the confidence is there. And I think it's the fun part of investing for me anyway. It's that this is a craft that, like a lot of crafts, you're always improving. So that confidence, or that, getting to the point where you go from being confident to, hey, not very confident, I think that's incredibly important. And Bob, you're right. That's not something you can necessarily read in a book and understand and grasp without it happening to yourself.
Yeah, and I think it goes to, the classic thing of the four stages of competence. Like for you listeners that are now aware, it's a classic thing that I think was developed or appear in the 60s, I think. Somebody mentioned it before. So it essentially breaks down into four stages, right? So the first stage is unconscious incompetence. Second stage is conscious incompetence. Third stage is conscious competence. And the final stage is unconscious competence. So when you start with investing, a lot of us are unconsciously incompetent. And that's where we make a lot of mistakes, thinking we know everything, but in fact, you're very, very incompetent at that stage of your investing career.
Yeah, that's perfect. And I think you grow as an investor, obviously. If you're not growing as an investor, then it's probably time to sort of offload your, I don't want to call it responsibility because we're obviously all responsible for our money, but just get someone else to help you with the investing part of it. Bob, what's one of the biggest mistakes that you have made as a investor in your you've been seriously investing for about 15 years now. What's one of the bigger mistakes that you've made?
Well, I think when I started off, just relying on other people to invest my money, right? So one of the biggest mistakes was investing in high MER mutual funds. These are mutual funds that charge anywhere from 2 to 3% MER every single year, regardless whether the funds are making money or losing money. You get in either way, so that really eats into your return pretty quickly. And then some of them could be front loaded or back loaded, so there are extra fees tagged on. So that was probably one of the biggest mistakes I did when I first started. Nelson, what about you?
Well, before I talk about one of my mistakes, I want to just reiterate the importance of fees and avoiding fees. And Bob, you talk about these mutual funds that you invested in. And I think that for a lot of Canadians who have gone the DIY route or the self-directed route, I think there's a big correlation between people who ditch their financial advisor or ditch the person at their bank who is selling them the funds, because ultimately that person's a salesperson, they're not really a financial advisor. I think there's a big connection between that and people who said, hey, I can do this myself. They just didn't want to pay the fees. And the fees are just such a no-brainer thing to cut wherever possible, because it all flows to your bottom line as an investor. And that just translates into more dollars that you keep in your account that aren't going to pay someone. And for me, that's kind of like the whole point of this podcast. And for me on Twitter and my newsletter and everything is that if I can empower investors to pay fewer fees, that benefits every investor, not just a select few. Now, I said earlier about, if you're not very good at investing, then by all means, get someone to help you, but get someone to help you in the lowest cost way possible. So whether that's using a service like, Wealthsimple charges significantly less than a traditional financial advisor. There are other products out there that are quite similar. I know BMO has one that is sort of the same, they call it Smartfolio. And that's sort of the same thing where you get that help and you don't pay as much money for that help. So, Bob, was there a motivation or a single event that made you say, hey, this isn't working, I need to sell all my mutual funds? Or was it gradual? I think we've talked about this before, but I can't remember. Enlighten me on that. How did you, I don't want to call it fix this problem, but I will, kind of for lack of a better term. How did you decide that fees were bad and that you wanted to go more self-directed approach?
Yeah, it was kind of gradual. I suppose a few events led to that. One was, when you invest in mutual funds, they always show you the percentage return. And in my younger days, I look at those returns and I could think of was, I can lose, and really wasn't thinking much about the fees and the benchmark against, the market, right? TSX or S&P 500. So that was one. And then two was we were kind of buying these mutual funds. My wife and I were kind of buying these mutual funds through so-called financial advisor, well, not even a financial advisor, but like an advisor at a bank. And when we started learning more and more about personal finance and investing, we started asking more questions. And one of the questions we asked to this advisor at the bank was, well, how much is your net worth? And we kind of just asked him within a range, and turned out he was way lower than us in terms of net worth. And my wife or girlfriend back then, we looked at each other, we're like, well, why do we want to listen to this guy when we could do so much better ourselves? And so step by step, we deviated from mutual funds and then started investing more and more on our own. I would say it was gradual for sure. It wasn't like a one step and then we just got out of mutual funds altogether. Just by me saying bad things about mutual fund, we still do invest in mutual funds. With my work's RSP, I could only invest in mutual funds. But what I do is make sure I invest in low NER mutual funds, and basically the index type of mutual fund. So these MERs are less than 1% in terms of fees. So by keeping the fees low, that's more money in our pocket at the end of the day.
Yeah, so that's it. You don't have a choice in terms of your work RSPs. So you did what you could to minimize the fees, which is exactly what you should be doing. And also, I'll note that you probably have a RSP match as well. So it doesn't make, why would you give up that free money in order to save a little bit on fees? It doesn't make any sense at all. So kudos. Like that's one of those financial moves that is just super easy, super smart. And it's easy to maybe galaxy brain your way into thinking that, I'm going to be smarter than this. I'm going to avoid these mutual funds. And in doing so, avoid the work match, which just makes zero sense.
Yeah, exactly. When your work match is, 3%, 4%, 5%, that's free money. So take advantage of that and just do as much as you can with work so they can match it. So Nelson,
exactly.
you were
easy, smart.
Yeah, you never answer your mistake. So do you want to talk about yours?
Well, that's because I've never, ever made a mistake in the history of investing, obviously. No, that's not true. Okay, I will air all my dirty laundry now, because the truth is I'm not going to say terrible when I first started. I mean, we're all terrible when we first start, but what I did, so I really started investing in the stock market in the kind of 2010s. Before that, I was almost strictly a real estate investor. I lived in a small town, there was real estate opportunities, and in the 2010s, those started to dry up. So I switched over to the stock market. And what I did is I spent a lot of time reading strategies and so on. And what I sort of settled on was this kind of deep value method of investing. So essentially what I was doing was I was looking at the worst assets I could find, but were trading at unbelievably cheap prices, because that was a strategy that worked very well in the 2000s, kind of when the tech bubble imploded and everything went to hell. That was a strategy that worked quite well. There was a lot of cheap stuff that when you bought it, it worked out as everything else went down. So I looked at that strategy and I said, yeah, I can replicate this. And what I did, I started out in kind of the 2011, 2012 period, and I ended up with a very concentrated portfolio in just a handful of different deep value names. And luckily for me, my portfolio was almost exclusively invested in real estate at that time. I was just using a relatively small portion of it to invest in these deep value stocks. And thank goodness that I did, because there was at least one that went to zero, and that was Jiangyang Printing. And I apologize if I've said that wrong, but that is obviously not my first language. So that one went to zero. That was a Chinese fraud that traded on the NASDAQ at the time. I bought Danier Leather, which was I'm sure a lot of people remember the stores. They were a fixture in Canadian malls for years. And that one went to zero. But I got a distribution out of that. So I only lost half my money instead of all my money, and so on. So I did this for years, I'm afraid to admit, until finally kind of 2 to 3 years later, figuring out that, hey, this is not a strategy that I can work with. And that's when I started going towards dividend investing. So that for me, I look back at the price of good assets in that 2010, 2011 period. Stock market's basically gone straight up since then. So for me, the biggest mistake was not necessarily doing the deep value approach. It was missing out on buying outstanding companies at relatively cheap prices where I should have been putting my portfolio.
Yeah, you live and learn, eh?
Yeah, it's just something I look back and that's the hard part, is looking back and seeing stocks like, it's not quite back then, but Microsoft was trading at 10 times earnings as recently as, 2014, 2015. And of course now it trades at 30 times earnings or whatever. But that's what I look back and just pains me in missing out of these great companies that were trading at such low multiples back then and were beginning to pay dividends because they just had the cash and wanted to start returning it to investors. It would have checked off all of my boxes back then, and I was too busy looking at trash that ended up going to zero. And it took me an embarrassing long time to learn from that and kind of say, hey, these stocks aren't any good. And just going from there, learning that mistake. I look back on it and I just can't believe how stupid I was. But that's the beauty of mistakes, isn't it? Is that if you don't learn anything, then the mistake is wasted. If you do learn something, then it's not so bad, because at that point I had, hopefully at that point, like 50 or 60 years of investing ahead of me. And it's just a blip on the long-term radar. That's, I think, an important thing, getting over mistakes, is that realizing that, hey, you made a mistake. It's not that big of a deal when you look at your time remaining as an investor.
Yeah, here's a good one for you. In terms of a mistake I made early on, was paying a lot of attention to analysts. So listening to what they say, and, do they give a stock a rating of buy, the hold, or sell, or their price target, and kind of just really listening to their top picks and things like that. And what I realized over time is these analysts, like 50% of the time, they don't know what they end up picking the wrong things, or on their best day, 50%. A lot of them have terrible records. And a lot of them also have very short-term views. Right? So they said, oh, it's a buy, and it's like a very short-term buy. And just kind of like mutual funds, where they are probably managing a fund of their own. So they're trying to get people to buy their funds. And that's the way they rate a stock. Sometimes there's some financial gains they could get out of that. So that was a pretty big mistake. Nowadays, I don't even look at analyst ratings or anything like that. It's really just call it a guidance for somebody that talks about stocks. Just, I would say, for the most part, ignore financial analysts. Really look at things from a long-term point of view. Like, who cares if Microsoft has one quarter that's not doing as well? Like, long-term, Microsoft will do well. So if it's all of a sudden gets a sell rating for analysts, or they have a bad quarter, maybe that's a good entry point for you to go into Microsoft and being able to have a low entry point and then hold it for the long term for a better return. So that's something I learned over the years as well. Nelson, do you have any other mistakes you made?
Oh, certainly. We're going to talk about chasing yield in a minute, but what I wanted to add on to your analyst point, because I think it's a great point. And what I've never understood is how analysts who just look at the short term, because that's what they are obsessed with, right? Like, that's what, at the end of the day, I think an analyst is a content provider. Just like you are a content provider, Bob, I'm a content provider. And what you want as a content provider is people to click and read your stuff. So analysts will put out updates or whatever, just looking at very short-term things because, hey, they're content providers and they got to put stuff out. And if they put out, hey, this is still a good long-term buy, then that's not really very good content for their audience. Their audience is short-term traders who want to take advantage of these sort of changes in sentiment. I read the transcripts for a lot of the quarterly conference calls for stocks that I own. And of course, analysts ask all these questions on them. And what you'll find over and over and over again is questions that are being asked in order for an analyst to update his or her model 3 months or 6 months out. And these aren't the kinds of questions that a long-term investor would ask. Like I was looking at recently at Allied Properties REIT, which of course the office REIT, which is struggling because office space is struggling. And almost all the questions are based, what do you see leasing activity looking like in the second half of 2025? It's basically all the questions, which is an important thing to monitor. But at the same time, it's like, as a long-term investor, I think we're more concerned with what the office space market is going to look like in 2030 or 2035 rather than this next quarter or the quarter after that. So when an analyst looks at things from the short term and you look at things from the long term, there's a disconnect there. And that's, I think, the biggest problem with analysts. If there are analysts who have a long-term view on the stock, and I think that FinTwit on Twitter is full of people who look much longer term, and this is a scenario where they're probably better analysts than a bank analyst on a stock, especially something that's kind of growing very quickly or whatever. So the other thing about analysts, and it's going to turn into a mini rant here, so I'm sorry, but there's often a financial relationship between a bank and a company in terms of they might use them to issue bonds, or they might use them to advise on a potential acquisition. So if a company is paying a bank money to help them in whatever, I really, really doubt the analyst covering that company from that bank is going to have an objective opinion. Something's going to come from higher up that's going to tell that analyst, hey, you're bullish on that stock. I don't care what you think, because if not, they're going to pull that business, and that's bad for the bank.
Yeah, there's a lot of things you need to realize in terms of analysts.
Yes. Anyway, so sorry, I was a bit of a rant against analysts, but I'm going to talk about the next big mistake I made. And I think this is something that a lot of dividend investors can relate to. They've done before. And Bob, after I'm done telling my story, I really want to get your thoughts on this too, because it's very, very common, I think. And that is chasing yield. So when I went from my deep value perspective to something more dividend focused, I like dividends because they were real and that it was a sort of a steady strategy that looked like it worked, whether the market was up or whether the market was down. And that attracted me to sort of this dividend investing. And that's evolved into more of a dividend growth investing mindset over time. But at that time, it was a dividend investing focus. So what I did is I would try to identify what I thought were good companies that were trading at temporarily low prices, and then get in on what I thought was a bottom floor. So it was almost like a value investing spin on dividend investing. So what I would do is I bought a number of stocks that were quite cheap, that paid really high dividends, because I was mostly attracted to the dividend. One that I chose was Aimia, which at that time was the owner of Aeroplan, which of course Air Canada's frequent flyer program, which Air Canada eventually acquired from Aimia. And Aimia paid a very high yield. At the time, I think it was 8 or 10%. It was very cheap. And the risk was that Air Canada wouldn't renew the contract. So I bought some shares, collected the dividend it was a couple of years. I held on to this one for a little while. And then Air Canada decided they were going to terminate the contract and create their own frequent flyer program. And Aimia's stock crashed 50, 75%, something. They eventually ended up selling Aeroplan to Air Canada, and instead of losing 75% of my money, I lost like 40% of my money. It wasn't the worst outcome. I mean, it's pretty bad, but it wasn't the worst outcome because I held on. I was patient, but I was more attracted to the dividend yield than the dividend growth. And now I've switched that, but that was part of the mistake I made back then. So that yield chasing really bit me. And it's a mistake every dividend investor makes. Bob, have you ever chased yield in your time investing? Do you have a story about that? Or just maybe talk about it a little more in general, kind of why it's such a hard thing for dividend investors to figure out?
Yeah, oh man, where do I start? Definitely made that mistake for sure. So classic example when we started was a stock called Liquor Store. And I had no idea what I thought this is like the liquor store that you see, right? But turns out they're the private liquor store and very high yield, but the yield wasn't sustainable. Another one we did early on during our dividend investing career was Energy Plus. And I think Energy Plus sells electricity or something in Eastern Canada. And again, very unsustainable yield. So, we got out and didn't lose too much money, but you live and learn. And then recently, I would say during, I think 2019, 2020, I was loading up on Inter Pipeline because the stock had a very high yield, but it was facing a lot of debt issues and it was facing some headwinds with the Heartland petrochemical complex project. But I was ignoring these potential warning signs and then thinking and convincing myself the high yield was sustainable. So what I did was I just ended up purchasing more and more shares of Inter Pipeline, and that stock was making a large percentage of our dividend portfolio. And then, when COVID happened, what happened to everybody? Everybody was staying home, didn't drive, right? So the crude oil price just dropped like a stone. And the entire oil and gas sector was crumbling, and Inter Pipeline, because they already had a lot of debt, it was just the financial side of things just deteriorated during that time. So, what happened to Inter Pipeline, it knew its dividend payout wasn't sustainable, so it cut its dividend by, I think, like 70 to 75% dividend reduction, which, I wasn't surprised, but it hurt. Right, our dividend income reduced by quite a bit because we had so many shares of Inter Pipeline. And then good old Brookfield, they came in and acquired Inter Pipeline. It was kind of call it unfriendly acquisition because the Inter Pipeline was doing so poorly financially. So Brookfield, they have so much financial power. They just came in and did a bit and eventually took over. So yeah, didn't make that mistake there. And you'll see this is a reoccurring event, unfortunately. And then we, like a lot of dividend investors, we bought AQN, and that was similar story as Inter Pipeline. We got bit there too. So yeah, it's tough because when you're a dividend investor, a lot of the time you're looking from the income aspect, and you may be willing to take a little bit more risk just to get a little bit more income. And sometimes you get bit in the rare end, sometimes you don't. So yeah, you just need to be a little bit careful, right? You need to make sure you have a good mix of dividend stocks. Don't put all your eggs in one basket, for example. So yeah, and really pay attention to the level of debt and free cash flow, all that sorts of matrix when it comes to dividend stocks that have very high yield. Nelson, are you still making the same mistake here and there, or you have learned from your mistake chasing yield?
Well, I think that as a dividend investor, it is impossible to completely avoid dividend cuts. They're going to happen. You are going to make decisions ultimately we're all security analysts, or at least those of us who invest in individual stocks are. And ultimately you're going to make decisions as an analyst that are bad. And those bad decisions are going to result in paying too much for a company or buying a company that the earnings collapse. And then when the earnings collapse, of course, the dividend cannot be paid and the dividend gets cut shortly after. So I think that if you're going to play in this part of the market, you're going to make mistakes and you're going to lose dividends via cuts. It'll happen. And Bob, your AQN, your Algonquin Power example is a great one because for the longest time for Algonquin, that payout ratio was very reasonable. Earnings were increasing, dividends were increasing. This was a solid company that just kept growing and kept getting bigger and kept generating more cash. And then suddenly it all kind of reversed and interest rates went up, which of course it was a big input cost for them. And you had the whole thing sort of just collapse and then you ended up with a dividend cut. Now, that one, I'm not sure anyone was really chasing yield when it came to Algonquin. Maybe at the end when the stock sold off so much and it just hadn't quite cut the dividend yet. So from that perspective, like I said, I'm not really sure anyone was chasing yield there. But at the same time, it's still easy to make that mistake. And I do, like I mentioned Allied Properties REIT earlier. I have a little bit of that in my portfolio. It is something that I bought as a long-term play on office recovering. And I went into it fully expecting that the dividend could be cut at some point because it's just, I knew what I was getting into. I knew that office would likely get worse before it got better. And that was a risk that I accepted. I think that's the big thing, is that knowing what you're getting into with an investment. If you're looking at something with a super high yield, know that the market is giving you that warning sign and you could potentially lose that income. As long as you're okay with that, as long as you're looking at it from a more total return perspective and you say, hey, I realize this risk exists, but it's not a portfolio breaker for me. What always concerns me is when I see people with large positions in these high dividend stocks. That worries me. I would put the kind of the bedrock of my portfolio, the vast majority of my assets, into companies with lower yields that have that potential for growth, and then mix in a few higher yields depending on the outlook of those companies. Bob, do you do that? Do you mix in sort of high yields to sort of help out your overall dividend yield, or have you just really been bitten by this, your Interpipeline story or your Algonquin Power story? So have you been bitten by this? So you just really just hang out in the smaller yield, higher growth portion of the market? Tell me how the dividend cuts impacted your portfolio.
We have a mix of high yield, lower dividend payout growth stocks and also low yield, high dividend payout growth stocks. It's a bit of a mix. And I think it's important, and everybody's will be different, especially in terms of your age. For example, if you're really relying on dividend income, you're, for example, retired, maybe you lean more towards the higher yield portion. And if you're younger and you're still accumulating your portfolio and you have time on your hand, then maybe you sway toward more the low yield portion. For us, we're kind of in the middle, I would say, maybe recently more on the leaning more toward lower yield. But we still have some high yield stocks. For example, TELUS and BCE. BCE recently cut dividends, and we knew that was coming. We were okay with it. And what we did was we were sort of limiting our exposure to BCE and TELUS and shifting more money toward some low yield stocks. But sometimes some stocks may fall out of favor. So a good example right now would be the Canadian Natural Resources. It's been taking a bit of a hit the last year or so, and we've been loading up on that particular slide. It's yielding about 5%, and we think is relatively safe. So yeah, I think it's just a handful, and I might be different than most dividend investors, where if a company cuts dividends, I don't immediately exit. I kind of see, and I take a wait and see approach, because I think sometimes a dividend cut means the company is trying to clean their books, and I kind of want to give the management an opportunity to prove themselves. So yeah, I think it's a tricky thing to say always. You can't just make out a rule saying, "Oh, don't invest anything higher than 5%." For example, one good example was we were loading up on Enbridge when it was, I think, under $40 a few years ago. The yield was north of 6%. I think it may have hit 7%, but we thought this is a very stable business, and pipelines are not going anywhere anytime soon. So we were loading up on Enbridge, and now I think last time I checked is $66. So we done well on that on Enbridge. So I think it's a mix of both. Nelson, what about you?
Well, one thing that I have sort of moved to over the years is I take a look at some of these sectors that generally have high yields. And one, Bob, you mentioned with Enbridge and pipelines, of course, you have a number of different companies in there in Canada. And for the most part, they all pay pretty generous dividends. So you look at pipelines, REITs are another one where you have virtually all the cash flow is paid out back to investors, which means high dividend yields. And from there, I really try to focus on sort of the higher quality names in each sector. So in pipelines, Enbridge is an excellent choice. There's quality there. They have these utility assets that go with the midstream oil and gas assets, and the utilities add that stability. So you've got that from Enbridge. And then you identify Enbridge as a quality pipeline company. TC Energy is a quality pipeline company. And you really just focus your attention on those ones. At least that's what I do. I really try to find quality, and then from there, pick from that for the high yield universe. So with REITs, I'm looking at something like Granite REIT or something like Canadian Tire REIT, where the payout ratio is a little bit lower and the growth potential is there. And you can see in the past that they have grown the company and that they've grown the distribution over time. That would be what I would do, is one, focus on quality, and then two, look at companies that do have that history of increasing their dividend in the high yield space, because that's generally a indicator of quality and an indicator of growth. And you don't need a huge amount of growth if you're getting a high yield, but that helps. Now, obviously, this isn't a foolproof way to look at it, because Bob, you mentioned BCE earlier, and BCE increased its dividend consistently up to the point where it said, hey, we've done too much here and now we have to cut it. So it's not perfect, but it certainly helps in terms of identifying potential dividend cuts before they happen.
For sure. And I think I want to mention one more really big mistake that I made over the past 15 years or so. And I think we kind of talk about it a little bit when we talk about the analysts. And really, it's not having a long-term view. And one really good example I have is, when I started working just before financial crisis, and when financial crisis hit, the Canadian banks really took a hit. And I think I bought Royal Bank back in February 2009 for just under $27. And back then I was really afraid that Royal Bank would drop even further. But Royal Bank didn't cut dividends. And back then I wasn't really looking at dividends. I was purely looking from a share price point of view. So I bought just under $27, $26.92 in fact. And I bought some, and then it kind of grew a little bit. And I think it hit just north of $29. And back then, it was a lot of people were talking about, oh, this financial crisis is going to get worse, that could bounce, et cetera, et cetera. And when it went about $29, I decided to sell all my Royal Bank stocks. And yeah, I think Royal Bank is at what, 190, something like that at the time of our recording here. So I didn't sell these Royal Bank stock, would have made a lot of money, but I wasn't really looking at a long-term view. And that was definitely a mistake I learned. And so during COVID, when everything was tanking, we went in and bought a lot of TD and a lot of CIBC, etc. I think we bought TD at $50, something like that. So I definitely learned my mistake of not having a long-term view. I knew COVID was a short-term event and that the market will eventually recover. So, I missed really big opportunity back in 2009. And when COVID happened, I was sure I don't want to make the same mistake. So I really put on my long-term view goggles and really took advantage of the depressed market at that time. So yeah, that was something I learned from the financial crisis. Nelson, do you have something similar?
Well, I was going to say that's just such a fantastic story because it goes to show that a long-term financial plan can really make you look like a genius in hindsight. And just like you, Bob, I was like a kid in a candy store during COVID, during that March 2020 decline, because I was seeing these long-term good companies just falling and falling and falling. And National Bank was a company that I had my eye on for a number of years at that point, and it had never gotten to the point where I thought it was cheap enough to buy. And I did buy during the COVID meltdown. I paid a little bit less than $50 a share. And as we're recording this, I think it's around 151 or 152. So it's a 200% return in 5 years plus dividends. That's a fantastic, fantastic result. But it wasn't that, my bank analysis skills were not the driver in that. The driver in that was having a long-term financial plan and having the mindset of, I want to pick up good assets that are going to pay me dividends for a number of decades in the future, and I can do so at a cheap price. That was the motivator, and that's what caused the decision. That, Bob, what caused your decisions as well was this long-term mindset. So I would encourage anyone, in fact, to kind of loop this back to financial mistakes. One of the financial mistakes that I made was not having a financial plan and not figuring out what my strategy was until I'd been in this game for a embarrassingly long time. That's the important part, is having a plan and then sticking with that plan no matter what happens. That's going to be a big source of good things for the average listener. Stick to that plan and do that.
Yeah, and just referencing back to COVID again, like we never bought at the bottom. I think that's around like March 21st or 22nd. We didn't bought at the near bottom, but we bought kind of a few days before, a few days after, and like we were just dumbfounded by some of the prices these stocks were. Right? I think we bought like National Bank, Nelson, you mentioned, at like $65, and I think Royal Bank at like $80 something. It just, everything was on sale. It was trying to move cash so we could take advantage of the depressed market. And it was very uncertain what was going on, and people were freaking out and all that sorts. But when you look at banks, it's like, well, people are going to put their money in banks, and people are going to, take out mortgages and things like that. They're going to make money regardless. So, take advantage of that. So it's definitely something I learned over the last number of years, is really look at long term and that was probably one of the reasons we got into some stocks like Google or Alphabet. We got in many, many years ago when it had a really bad quarter and the stock dropped quite a bit. And again, putting on the long-term goggles, I thought Google will continue to dominate in the internet space. So bought a lot of shares back then and has done well. Right. And then another example, maybe this wasn't really stock related, but remember when Canadian dollar was over parity to US dollars?
I remember.
So,
My Las Vegas trips remember too.
It was a lot cheaper to convert. So what I had a bunch of money sitting around and I converted a lot, I think 100 grand or something, Canadian into US. And right away, that's, I guess, 30% return, 40% return because of that. So again, really look at your investment from a long-term point of view. Don't look at, 3 months, 6 months. That's just noise, in my opinion. And, looking at a decade kind of time frame, right? I think Warren Buffett mentioned this is, you should invest a stock as if you're not going to touch it for at least 10 years. And that should be your mentality.
That's a fantastic mentality. I always agree with Warren Buffett, but I especially agree with him on this part. So I'm going to wrap up this episode today, but just very quickly before I do, just for everyone listening, realize that you're going to make mistakes and mistakes are not the end of the world. Bob and I just spent 45, 50 minutes here talking about our mistakes, and we both ended up just fine despite making mistakes and making the same kinds of mistakes that everybody makes. So if you're discouraged because you bought something that it cut its dividend, if you're discouraged because you picked a wrong strategy or you didn't take a long-term view or whatever you think that your mistakes have been, don't sweat it. You have likely have a long investing life ahead of you, and there's going to be plenty of time to fix these mistakes. And most importantly, you learned that lesson. And that's the thing that's going to separate a good investor from a so-so one, is that they figure out where they've gone wrong and they learn from those mistakes, just like I did and just like Bob did. So Bob, as always, thank you for joining me. And we are very excited for the upcoming episodes we have. We have a bunch of good stuff for you guys. So stay tuned, and thanks for listening. Bob, you want to say the last word?
Yeah, thanks for listening, and really limit your exposures. If you, it's okay to make mistakes. It's making sure these mistakes don't cause too much damage to your portfolio. So really limit the big mistakes. Little mistakes are okay as long as you learn from them. Yeah. So until next time, it's been fun recording this episode.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.